Hello everyone, welcome to another lovely episode with Jayfx. Welcome to another episode on Elliott wave pattern. All right, so for those of you who followed up with the previous videos on harmonic, patterns, we kind of like gave a conscious breakdown of the pattern from the history, the logic, and basically how they reflect on Fibonacci ratios. Okay, so I kind of did multiple series, about 9 episodes on harmonic patterns, which is available on the YouTube. Okay, so you can go and watch that if you want to learn more about that. But for this, which are on blue background, as you can see, the video is on blue background. We have multiple videos on blue backgrounds, but they are all based on Elliott wave pattern, which is this theory of Elliott wave, the 1, 2, 3, 4, 5 ABC. Okay, so whenever you see an episode like this, we're talking about Elliott wave, just like the description is being, showed on, the thumbnail of the video. All right, so on today's video, I'm going to be breaking down the WXY pattern. Okay, this you're seeing on the screen is a previous analysis I did on the most recent episode, the last episode we had on Elliott wave. So you can go and watch that. I made this prediction, so I decided to start from this point so we can see what's going on. All right, so from this analysis, I think the market was at this point. Okay, so from this, I think we just finished the wave B, which is a correction, as we can see here, A, B, C. This is an impulsive. So probably now we're in the wave C leg, and that's something that could be happening like a 1, 2, 3, 4, 5. Depends, but my bias is still bullish, and this is still a bullish market. So on that perspective, I'm not really going to be giving you guys much insight because the market is not really, in any different from the previous analysis. We are still playing out. So this aside, I'm going to shift this now. So let's focus on this pattern. Okay. So I did this so I can give you guys insight why this particular video is not actually an analysis class, but instead a study section on a particular method. Okay. So I'm taking this out now so we can get back to the topic of the day. All right, so let's look at the WXY pattern. For those of you who don't know, I made an ebook for Elliott Wave, which the ebook is available on the Telegram channel. The link is in the description. This pattern we're about to break down was not really reflected on the ebook, or it wasn't reflected on the 9 episode we had on Elliott Wave earlier this year. Okay, so we did that one before we went to harmonic patterns. And before that, we did I think it was Wyckoff. We did Wyckoff. So there's also Wyckoff. There's Wyckoff breakdown, there's harmonic breakdown, and this is, an episode on Elliott Wave following the episodes of the mentorship. All right. So this is mainly for this pattern. Why? Because we did not have any key, insight on the rules or how to use this pattern on the ebook. Okay, so the ebook is in the description. You can go get that and get insight on Elliott Wave, the history and how the pattern evolved into now, and why it's a logical, technical method in analyzing the financial market. Okay, so the functions of the WXY pattern, it's a corrective pattern. Okay, so it's meant to be a retracement. It's meant to help you understand the retracement of a main trend. As I mentioned on the ebook, the 1, 2, 3, 4, 5 pattern is an impulsive pattern. It's in the direction of the main trend. Okay. And then we have the traditional A, B, C. Now I'm going to make this all make sense together. So I'm kind of like going to pile everything up. So we're going to start having much um 1, 2, 3, 4, 5 ABC on the screen. So if you're following up, it's going to be easy for you to understand. If you're not, you're going to get lost along the way. So just follow up with me, okay? So now we have the ABC, which I taught you guys on the ebook. So this is where I stopped. I gave you guys insight on 1, 2, 3, 4, 5 and ABC, which is the fundamental basic patterns of um Elliott wave. So along the way, they got the WXY. So the WXY is kind of like a more complex corrective structure, a corrective pattern. It gives insight into what could be happening within this range. Now, let's say this was a bullish trend, okay? And this we are having here is the impulsive structure. Now, since this is a technical method, logically, we can see that, let's say the retracement of wave ABC never really got to the discount of the 1, 2, 3, 4, 5, which means there's likely every possibility that price is still bearish and, there could still be more retracements and price getting to this point. But then you can see clearly something like what happened here, 1, 2, 3, so you can count the ABC pattern and you see the correction. But using Fibonacci ratio, let's say using Fibonacci ratio, you can clearly see there are more key levels below, and price could be making a more complex correction. So you're not convinced that this is bullish and you might be bearish, maybe based on smart money concept or something like that, something like a change of character, and then you're looking at price doing something from here. Okay. So this brings up the possibility of what if you're still bearish? And that's where patterns like the WXY comes in. It helps us to understand how complex corrections can still happen even within, internal structures. So I'm going to break this down more by making it make sense with the ABC pattern. That is, what kind of pattern forms within the wave W. Remember, each wave is a range, and each range is formed by an internal structure, which is an internal pattern. So 1, 2, 3, 4, 5 forms with 1 because it's impulsive. ABC forms with 2 because it's the correction of wave 1. 1, 2, 3, 4, 5 forms with 3 because it's impulsive, which is also the longest wave, within the impulsive 1, 2, 3, 4, 5. And then ABC forms with 4, or maybe something like an WXY forms with 4. Okay. And then we have a 1, 2, 3, 4, 5 forming with 5. So it's always wave within wave because we're actually analyzing multiple time frames. We're looking into different time frames at the same time. Okay. So now we have the ABC. Now this ABC pattern we have here is a pattern that can also make up the WXY because it's a corrective pattern, and the WXY originally it's a corrective wave. So it starts to make sense why it's still a corrective wave, and then it's something you see within a correction. So within this video, I'm going to give you guys like let's say rules to help you identify um the WXY pattern, because I just broke how it makes sense within the 1, 2, 3, 4, 5 and ABC, why we still have something like this. There are other patterns like the zigzag, I think WXYYZ, something like that. But maybe in the future we'd have breakdown on those patterns. But I'm giving you guys this because I've taught you guys about premium and discount in terms of smart money concept. And all these are technical methods that when you put them together, they make more sense. So I'm giving you guys advanced level of Elliott wave, believing that you guys understand the 1, 2, 3, 4, 5 and the ABC. Okay. So when I mean rules to identifying this, I'm just talking about things you have to pay attention to make this pattern make sense. All right. First of all, you have to understand that with W and with Y are corrective bearish patterns. Okay. So they are bearish patterns in the sense that they are a correction of the main trend. So when you're looking at something like this, this could be a W and this could be a Y. Okay. So X is always a bullish retracement, something like this. So what's the difference between ABC and WXY? Well, as you can see, it's basically patterns within patterns. And there are other structures in terms of Fibonacci ratios that are used to classify this. Okay. So for me personally, it's all about market structure, and you can easily just, understand them using market structure. But not to get confused, when you identify ABC and you call this an A, and then ABC and you call this a B, and then ABC, you call this, a C, it kind of look like you don't really know what you're doing because you're just saying ABC, ABC, ABC. So it's logical to give these complex structures a different term to make them make more sense. You understand? So I'm not saying there's a difference between the ABC and the WXY corrective pattern. These are all identifying corrections. So they are supposed to look the same, But the difference is that on WXY, you can have something like a 1, 2, 3, 4, 5. Now, this also brings the picture of, let me take this out. Okay, so this also brings the picture of, can you call a C a 1, 2, 3, 4, 5? Right? So you see why we have some of these terms. A wave C, yes, can be impulsive because it's a corrective pattern, right? But at the same time, something like this brings a complex correction to the picture. Okay, now we know wave X is a corrective pattern. And also wave X cannot go above the high of wave W. You know, I don't think I've seen something like that before, because this is supposed to, wave X is supposed to be a retracement within wave W, you know, something like this. So in cases where we have something like this, that would be a different pattern, you know, because that's clearly an impulsive pattern. You know, the trend is bullish. So it doesn't really make sense to call this, you know, a correction anymore if it's already breaking the external high, you see. So this is always kind of like within this range to make everything make more sense as an internal structure. Because at the end of the day, this is all just an internal structure of this bigger range. Do you understand? So it's supposed to be within the range to make it make sense. So I don't think it's supposed to go above this high. And this is how it's supposed to actually look. So also, wave W can appear in the form of 1, 2, 3, 4, 5. But wave X has to be in form of an A, B, C. And that's because it's supposed to be a correction, like what I just explained to you guys earlier. So it's supposed to be a correction within um, wave, you know, W. So it can't really be um it can't really be an impulsive move. Okay. But also there's something you guys have to understand is that wave A can still be an impulsive move within this. Wave B can be a retracement because you know it's a retracement of wave A, and this can be impulsive. So this is where Elliott wave gets more complex and complex. You know, it's a technical method. It's supposed to do more, you know, the more you understand it, the better it becomes. So these patterns are not like something unique that without proper understanding or without rules or formats, you can't really get them. You just have to know how they work. Okay. So I just broke down the science of how WXY plays a role in the basic 1, 2, 3, 4, 5 and ABC pattern. So you can also understand it. So when you see a WXY and you're like, okay, you learned a lot way from Jayfx, but you never really taught you about this WXY pattern. Now you see what it's all about. This is basically what it's all about. Now, this pattern, like I explained earlier, can be in an impulsive form or in a corrective form. So wave W and wave Y are in the same direction. Wave X is a correction within these guys. So this wave puts these guys together to form the corrective pattern of this structure. Okay, so this can be in ABC, 1, 2, 3, you know, as long as, you know, it's an impulsive wave. So you can see an impulsive drop like this, a retracement, an impulsive drop like this. But on the lower time frame, it can be broken down with, you know, wave patterns like this. This is the daily time frame. So I'm just trying to make this pattern make sense. Okay, so that's all for this video. I'm trying to make it short so you guys have insights to how these patterns work. So on the next episode or in the future episodes when I'm making analysis and trying to use these patterns to predict the market, they are not new to you. They are not, you know, foreign. Now you have insights to how they work and what they use them for. And if you find this video educational or you find it entertaining or helpful, you can subscribe and, you know, look forward to the future episodes. Thank you for watching. Bye.